Every financial advisor managing money for people over 60 follows the same playbook. They'll tell you to maintain a balanced portfolio, maybe 60% stocks, 40% bonds. They'll say you need growth to outpace inflation. They'll show you Monte Carlo simulations proving you won't run out of money. They'll rebalance quarterly, charge you 1% annually, and send glossy reports showing how they're optimizing your retirement. Here's what they won't tell you. Their incentives are completely misaligned with your actual needs. And this misalignment is costing you the one thing you can't afford to lose at your age: safety. I've spent 5 decades in institutional investing. I co-founded Oaktree Capital, where we manage over $170 billion. Warren Buffett reads our investment memos. But more importantly, I've watched what happens to people in their 60s and 70s when their advisors follow conventional wisdom during market dislocations. I saw it in 2008. I saw it in 2020. I saw it again in 2023 with the regional bank crisis. The pattern is always the same. The advice sounds prudent, the reasoning seems logical, the credentials are impressive, and the results are devastating. Let me prove it to you with numbers, not opinions. Before I continue, I need to know who I'm talking to. Drop your age and whether you're currently working with a financial advisor in the comments. And if you're serious about protecting what you've spent a lifetime building, subscribe now. This channel isn't about hot tips or market predictions. It's about second-level thinking, the kind of risk-aware approach that's preserved capital through 8 market cycles. Now, here's what I'm going to show you in the next several minutes: the 5 lies your advisor tells you, why each one violates basic principles of risk management, and what you should demand instead. But you have to stay until the end, because the most dangerous lie is the one I'll address last. Let me start with what most people get wrong about financial advice after 60. They think their advisor's job is to grow their money. They've been taught that wealth management means maximizing returns. Every retirement planning book tells them to stay invested for the long term. But here's what 50 years of data actually shows. After 60, your primary job isn't growth, it's protection. Not because growth doesn't matter, but because you've lost the one asset that made aggressive investing rational when you were younger. Time to recover from mistakes. This isn't opinion, this isn't theory. This is pattern recognition across 8 market cycles, 4 major crises, and thousands of investor outcomes I've observed. And it all comes down to asymmetric risk. Not balanced portfolios, but understanding that losses hurt you far more than equivalent gains help you. I'm going to break this down into 5 lies your advisor tells you. Each one sounds reasonable. Each one is taught in financial planning programs, and each one can destroy your retirement security. Miss one and you might survive. Believe all 5, and you're gambling with money you can't afford to lose. Let's start with the lie that causes the most damage. The first lie is this: you need equity exposure to outpace inflation. Your advisor will show you charts. Over the past century, stocks returned 10% annually while inflation averaged 3%. Therefore, you need stocks. The math seems irrefutable. Here's what's wrong with this reasoning. You don't have a century, you have maybe 2 or 3 decades, and within any 2 or 3 decade period, the sequence of returns matters enormously. If you experience a major drawdown early in retirement while you're taking distributions, you can permanently impair your capital. This is called sequence of returns risk, and it's the silent killer of retirement plans. Let me show you this principle in action. In March 2023, Silicon Valley Bank collapsed. Within days, Signature Bank and First Republic followed. Depositors panicked. The regional bank index fell 47% in 3 weeks. Now, your advisor probably told you that you weren't exposed to this because you held diversified bank stocks or bond funds, not concentrated positions in regional banks. But here's what happened to many retirees I know about. They held bond funds that were down 15 to 20% because interest rates had risen sharply. When they needed to take their regular distributions, they were selling bonds at the worst possible time. Their advisors had told them bonds were the safe part of their portfolio, but bond funds aren't safe when rates rise. They're volatile, and volatility matters when you're taking money out. The investors who understood this principle, that you can't afford volatility when you're distributing capital, had positioned differently. They held individual bonds to maturity. They kept significant cash reserves. They weren't forced to sell anything during the crisis. At Oaktree, we've always maintained that defensive positioning matters more in good times than in bad times, because by the time the crisis arrives, it's too late to get defensive. Now here's the second-level thinking. First-level thinking says you need stocks to beat inflation. Second-level thinking asks, what's the actual inflation rate for my specific spending, and what's my personal tolerance for seeing my account balance drop 30 or 40% right when I need the money? When you ask that question, you realize that the risk of a major drawdown often outweighs the benefit of slightly higher expected returns. This is what separates people who maintain their standard of living through market cycles from people who have to make painful adjustments at the worst possible time. So, what do you actually do? You calculate how much you'll need to spend over the next 7 to 10 years. You hold that amount in instruments that mature when you need the money: individual treasury bonds, CDs, high-quality individual corporate bonds, not bond funds. Individual bonds that you can hold to maturity. This isn't complicated, but it requires accepting lower expected returns in exchange for eliminating sequence of returns risk. Most advisors can't accept this because it looks too conservative on paper and generates less fee revenue. But this creates a new problem, because the first lie leads directly to the second lie, which is even more insidious. The second lie your advisor tells you is this: we'll rebalance to manage risk. This sounds sophisticated. When stocks go up, they sell some and buy bonds. When stocks go down, they sell bonds and buy stocks. They're maintaining your target allocation. They're being disciplined. They're doing something. Here's what they're actually doing. They're forcing you to buy assets that have become more expensive and sell assets that have become cheaper, regardless of whether the valuations make sense. They're following a mechanical rule that ignores market cycles, valuations, and risk positioning. And they're doing it because it's easy to explain and easy to systematize, not because it's optimal for you. I've written extensively about market cycles in my memos. Markets are cyclical. They swing like a pendulum between overvalued and undervalued, between euphoria and despair, between greed and fear. Where you are in the cycle matters enormously. Rebalancing ignores this completely. Let me give you a specific example. In 2021, stock valuations reached levels we hadn't seen since 1999. The Shiller P/E ratio hit 38. Corporate profit margins were at record highs. Interest rates were at zero. Any rational assessment of forward returns suggested stocks would underperform for years. But your advisor was still rebalancing you into stocks if they'd gone up, and your allocation had drifted. They were forcing you to buy expensive assets. Then, in 2022, stocks fell 25%. Bonds fell 13%. It was one of the worst years for balanced portfolios in history. And in 2023, your advisor rebalanced you back into stocks as they recovered, right before the regional bank crisis hit. You were whipsawed. You bought high, sold low, and paid fees for the privilege. The evidence for this principle is overwhelming. Over my career, I've observed that the best investment results come from being defensive when others are aggressive and aggressive when others are defensive, not from mechanical rebalancing, from cycle awareness, from understanding when assets are priced to deliver good returns versus when they're priced for disappointment. Bruce Karsh and I have discussed this for decades at Oaktree. Our entire investment approach is built on being patient, holding cash when we can't find good opportunities, and deploying aggressively when others are panicking. In 2008, when credit markets froze, we raised $11 billion for distressed debt. We weren't rebalancing. We were recognizing that the cycle had created extraordinary opportunities, that capital generated returns in the mid-20s annually for our investors. This is second-level thinking in action. First-level thinking says rebalancing is prudent and disciplined. Second-level thinking asks, what are we rebalancing into? At what valuation? At what point in the cycle? And does this make sense given forward return expectations? When you ask those questions, mechanical rebalancing often looks foolish. So what should you demand instead? You should demand that your advisor explain their assessment of where we are in the market cycle, what valuations suggest about forward returns, and why any allocation change makes sense given these factors. If they can't answer these questions, if they just say, we rebalance to maintain your target allocation, they're not thinking. They're following a rule. And following rules without thinking is dangerous with money you can't replace. This leads to the third lie, which is particularly insidious because it sounds so reasonable. The third lie is this: diversification protects you. Your advisor will show you how your portfolio is spread across large cap, small cap, international, bonds, maybe some alternatives. Look how diversified you are. Look how many asset classes you own. You're protected. Except you're not. Because in major market dislocations, correlations go to 1. Everything falls together. Your diversification disappears exactly when you need it most. I saw this in 2008 when nearly every asset class fell. I saw it in 2020 when the COVID crash hit. I saw it in 2022 when stocks and bonds both fell significantly. Here's what most people don't realize. Diversification across correlated assets isn't diversification. It's false comfort. Real diversification means holding assets that behave differently in different environments. But most retail portfolios are just different flavors of the same risk. They're all long equities and credit, all benefiting from economic growth and low volatility, all vulnerable to the same shocks. After the 2008 crisis, I wrote a memo about this called The Limits of Diversification. The key insight was that diversification works in normal times but often fails in crises. The only real protection is holding genuinely uncorrelated assets, cash, treasury bonds, certain types of volatility strategies, or being willing to hold cash and wait for opportunities. At Oaktree, when we couldn't find attractively priced opportunities in 2005 through 2007, we held cash. Lots of it. We were criticized. We were losing clients who wanted us to be fully invested. But we understood that holding cash when you can't find good opportunities isn't a cost. It's risk management. And when 2008 came, that cash became our most valuable asset because it allowed us to be aggressive when others were desperate. Now watch what happens when you apply this principle to a retirement portfolio. Real diversification for someone over 60 means holding enough genuinely safe assets, not bond funds, not diversified stock portfolios, but actual cash and individual bonds that you can survive a multi-year downturn without selling anything at depressed prices. It means accepting that you might underperform in strong bull markets in exchange for not being forced into painful decisions in bear markets. This is where conventional wisdom fails completely. Your advisor's definition of diversification is spreading your equity risk around. The correct definition is having enough truly safe capital that you never have to sell risky assets at the wrong time. These are completely different concepts. One is about feeling diversified, the other is about being protected. So what do you actually do? You divide your portfolio into 3 buckets. Spending money for the next 7 to 10 years in individual bonds and cash, long-term money that you won't touch for a decade or more that can be in stocks, and opportunistic money that you can deploy when everyone else is panicking. This is real diversification. This is what protects you, not owning 17 different mutual funds that all fall together. But here's where it gets critical, because the fourth lie is the one that keeps you trapped in this system. The fourth lie your advisor tells you is this: you're not sophisticated enough to manage this yourself. They'll say you need professional management. You need their expertise. You need their research capabilities. You need their discipline to keep you from making emotional mistakes. This is self-serving nonsense. Managing a retirement portfolio after 60 isn't complicated. It's just different from what they want to do. They want to actively manage, trade frequently, show activity, justify their fees. You need to hold individual bonds to maturity, maintain cash reserves, avoid unnecessary volatility, and wait patiently for genuine opportunities. The evidence is clear. Study after study shows that most active managers underperform simple index funds after fees. And for retirees, the evidence is even more damning. The complexity your advisor adds, the rebalancing, the tactical allocation changes, the manager selection, usually subtracts value after fees while adding volatility you can't afford. I've spent 50 years in professional investing. I've managed billions of dollars. And I'm telling you that the investment strategy appropriate for most people over 60 is simpler than what they're currently doing. Not because simple is always better, but because the specific situation of retirement, needing income, unable to replace losses, lacking time to recover, demands simplicity and safety over sophistication and activity. Here's what you need to understand. Your advisor's business model depends on complexity. They need you to believe that managing money is complicated, that you need their expertise, that you can't do this yourself. Because if you understood that the optimal strategy is to hold individual bonds to maturity, maintain cash reserves, and only invest in stocks with money you won't need for a decade, you might realize you don't need to pay them 1% annually. This principle has saved me repeatedly throughout my career. The most important investment decisions are often the simplest. Don't overpay for assets, don't use leverage, don't invest in things you don't understand, and don't take risks you can't afford. These aren't complicated, but following them requires discipline and patience, not sophisticated analysis. So, what should you demand? You should demand that your advisor explain exactly what value they're adding that justifies their fee. Not what they're doing. Activity isn't value, but what measurable benefit you're receiving. If they can't articulate this clearly, you're paying for the appearance of sophistication, not actual benefit. This leads to the final and most dangerous lie. Pay attention to this one, because it's the lie that prevents people from making the changes they need to make. The fifth lie your advisor tells you is this: making changes now would be market timing. If you want to get more defensive, they'll say you're trying to time the market. If you want to hold more cash, they'll say you're letting fear drive decisions. If you want to simplify your portfolio, they'll say you're abandoning a proven strategy. They'll make you feel like any change is irrational, emotional, or naive. This is perhaps the most insidious lie because it uses your own prudence against you. You don't want to make emotional decisions. You don't want to time the market. So you stay with a strategy that isn't appropriate for your situation because changing it would feel like market timing. But here's the reality. Adjusting your risk positioning based on your age, your needs, and market conditions isn't market timing. It's rational risk management. Market timing is trying to predict short-term price movements. Risk management is saying, I can't afford a 40% drawdown, so I'm going to position defensively regardless of what happens next. These are completely different concepts. In my most recent memos, I've addressed this extensively. I don't predict markets. I don't know if stocks will be higher or lower next year, but I do know how to assess risk, how to recognize when markets are priced for perfection, and how to position defensively when the risk-reward trade-off is unfavorable. This isn't market timing. It's cycle awareness. Let me connect these 5 lies to show you how they work together. Your advisor tells you that you need equity exposure to beat inflation, so you're taking risk you can't afford. They rebalance mechanically, forcing you to buy expensive assets and sell cheap ones. They give you false comfort through diversification that doesn't actually protect you. They convince you that you need their sophistication when simplicity would serve you better, and they prevent you from making necessary changes by labeling any adjustment as market timing. The result is that you're positioned for their benefit, not yours. You're taking unnecessary risk. You're paying fees for activity that subtracts value. You're holding a portfolio that's too complex and too volatile for your actual needs, and you're trapped because changing course feels like admitting you made a mistake or trying to time the market. This isn't about your advisor being malicious. Most of them genuinely believe they're helping you, but their training, their business model, and their incentives all push them towards strategies that generate fees rather than strategies that protect capital. The system is designed this way, and you're the one who pays the price when it fails. So how do you actually implement this? Let me give you the specific framework I'd use if I were managing retirement capital today. Calculate your spending needs for the next 7 to 10 years. Hold that amount in individual treasury bonds, CDS, and high-quality individual corporate bonds that mature when you need the money. This eliminates sequence of returns risk completely. You know exactly what you'll have, regardless of what markets do. For money you won't need for a decade or more, you can hold stocks. But only stocks, not actively managed funds with high fees, simple, low-cost index funds, and only with money you're genuinely willing to see drop 40% without panicking. Keep the rest in cash or very short-term treasuries. This is your opportunity fund. When the next crisis comes, and it will come, you'll have capital to deploy when others are desperate. This is how wealth is preserved and grown over decades, not through constant activity, but through patience and opportunism. Now, here's what you need to do in the next week. Schedule a meeting with your advisor. Ask them these 5 questions. How much of my portfolio is in individual bonds that I can hold to maturity versus bond funds? What's your assessment of where we are in the market cycle, and how should that affect my positioning? What percentage of my portfolio is in genuinely uncorrelated assets versus different flavors of equity risk? What specific value are you adding that justifies your fee? And if I want to get more defensive, why would that be market timing rather than rational risk management? Their answers will tell you everything you need to know. If they can't answer these questions clearly and specifically, you're paying for a service that isn't serving you. And at your age, with money you can't replace, that's a risk you can't afford. That's where we started. Now you understand why the conventional advice fails. Financial planning for people over 60 isn't about maximizing returns. It's about eliminating the risk of permanent capital impairment while maintaining your standard of living. These are completely different objectives. One is about performance, the other is about survival. I've spent 5 decades learning this. I've watched thousands of investors make these mistakes. I've seen what happens when people follow conventional wisdom during crises. And I've distilled it down to these 5 lies that your advisor tells you, often without even realizing they're lies. You now know what took me 50 years to learn. You have the framework. The question is, will you use it? Because here's the reality. Most people will read this, nod along, and change nothing. They'll go back to their advisor's office. They'll accept the reassurances. They'll make the same mistakes. They'll get the same results. Don't be most people. Before you go to bed tonight, calculate how much you'll need to spend over the next 7 years. Write it down. That's the amount that should be in individual bonds and cash, not at risk in the market. That's your first step. And subscribe if you haven't already, because this channel is about thinking differently about risk. This is about protecting what you've spent a lifetime building. This is about understanding that after 60, the game changes completely. Market cycles are inevitable. Losses are painful. Time is finite. That's what 5 decades of investing teaches you. That's what surviving 8 crises shows you. That's what managing $170 billion proves. Protecting your retirement is possible, but only if you understand that the conventional advice your advisor gives you is designed for their benefit, not yours. I can't change your advisor's incentives. I can only show you what's actually in your best interest. The rest is up to you.